Hi, everyone, and welcome to today's webinar on how community lenders can compete in the subprime market. I'm Theodora Haji Michael, Chief Executive of Responsible Finance. Today's webinar is part of a wider series of events that Responsible Finance is holding called 10 times RF in order to increase the awareness of the critical role that community development finance institutions, or CDFIs, play. And we've got a really great lineup of speakers for you today, which I'll introduce now. So Faisel Rahman is Managing Director of Fair Finance, a CDFI. Faisel has been involved in financial inclusion for nearly 25 years, working across microfinance, debt advice, and developing affordable credit tools. Sacha Romanovitch is the CEO of Fair for All Finance. Fair for All Finance was founded to increase the financial well-being of people in vulnerable circumstances through access to fair products and services. Alice Tapper is the founder and author of Go Fund Yourself, a financial news and education platform for young people in the UK. In 2020, she launched the successful Regulate Buy Now, Pay Later campaign, which led to the FCA's decision to bring those products under its remit. And Jason Wassel, Chief Executive of the Consumer Credit Trade Association, which represents alternative lenders in the commercial space. He has a background in policy, risk, and communications. Chairing today's discussion is Simon Reed. Simon is the former personal finance editor at the Independent newspaper, and he now reports on finance matters for the BBC, Evening Standard, and others. So thank you again to all of our speakers. Simon, over to you.
Thank you very much, Theo. I'm really excited about being here today because the whole thing about debt and credit is really close to my heart. You know, I like to think of myself as a campaigning journalist. When I was at the Independent, we had several front pages about predatory payday lenders. There was a big old scandal, which led to changes in the law. And it's so important to ensure that people who are hard up aren't being preyed upon by unscrupulous lenders. The latest move in this field, as you all know, is Provident Finance. The doorstep lender has decided to pull out for lots of reasons. One of the ones is that the regulators are on their back and are squeezing them. They can't actually maintain their business any longer. Now, they're an interesting one, Provident, been around for 150 years, and lots and lots and lots of their customers absolutely love them, despite the fact that there's high charges, despite the fact that, you could say that they were being ripped off. But their secret, which I quite admire, was that they put their customers first. They put their customers at the heart of their lending. An example of that was they knew all their customers, they knew all the family members on when their birthdays were. So the local rep will pop round, knock on the door and say, hello, Bob, Jean, whatever. It's your daughter's birthday, your son's birthday next week. Congratulations. How are things going? And then would come stinger. How are you going to pay for it? And the family would say, well, actually, we can't afford much. And the doorstep lender would say, well, why don't you take out another loan? So it was quite nefarious what they did. But, they did what's important, which is put the customers first. And people felt like these lenders were their friends, when obviously they weren't. They were just making big profits out of it. Now, that's the key thing for me today, is putting people at the forefront of this. We're going through a lot of changes in this industry. There are a lot of people who need to borrow. The fact is, I guess at a very basic level, debt is a dangerous thing, but we all need to be in debt. I've got a mortgage. Without my mortgage, without that huge, great debt hanging over me, I wouldn't have a nice home. So we all need debt in different ways, in short term, long term, and it's a way to help us enable to get better things in our life, how to get on. The problem is when it becomes unplanned debt, dangerous debt, when people borrow too much, interest rates are too high, the lenders are too predatory, and that's where responsible credit comes in, responsible debt, and there's a world opportunity out there for actually lenders who do put people first, who try and help them rather than simply make a profit out of them. That's what this is all about today. Interestingly, Provident had something like 350,000 current borrowers, you know. So what's going to happen to them all? Now, the danger is that they fall into what you might call backstreet lenders. This could be the bloke down the pub who's happy to you know, lend people a couple £100 for a massive, you know, 50 quid, 100 quid extra, you know, on top. So we don't want that to happen. So it's really quite important now that the you know, consumer credit companies step up into this void and fill in. So I'm really fascinated to hear what everyone is going to say about this. I think you know, there's no simple solutions, but there are some interesting things we're going to debate today. So I'm going to start off by asking Faisel to talk about himself and what they do. So Faisel, if I could pass over to you, so once you're done, we're going to go on to Sacha, Alice, and then Jason. And everyone's got some really interesting things to say, which I'm really looking forward to hearing. So Faisel, over to you, mate.
Thank you, Simon, and thanks for the invitation. So my name is Faisel. I'm the founder and CEO of Fair Finance. As Theo mentioned, I've been involved in the world of financial inclusion for the better part of the last 25 years. I've had the privilege to see what works internationally, both in South Asia and in Europe. I've seen how many organisations and funders have come together to provide an alternative to the high-cost credit markets wherever it exists around the world, rooted in microfinance. I've also seen what's not worked, how scaling fast can cause organisations to lose mission focus and also struggle to manage demand, and how misaligned objectives and funders can lead to poor customer outcomes. When I launched Fair Finance in 2005, it was to be an alternative to the high-cost credit market. And in many ways, you know, much of that market has changed over the last few years. And in some ways, for us as community lenders, we need to move beyond thinking about us simply as an alternative to the high-cost credit market and start thinking about reimagining the entire credit market. We're only going to do that if we see ourselves as a small part of a bigger picture, an entire credit sector. And in order to do that, many of the things that have made Fair Finance successful over the last 15 years, we're going to have to do in different ways. There are things that all of us are doing around figuring out what products and what customers we're serving, because they're changing rapidly, what our service looks like, because it's evolving very quickly, and who our funders are, because we need to find ones that aren't tied to short-term objectives, but more long-term ones. But as Simon just touched on, the entire sector of credit is changing. We've seen that more recently with the Provident, but only in the last couple of years, we've seen that with the Bright House, Peachy, and Wonga loans. It's not necessarily what we do that's important as we grow. It's going to be how we do that. And in order to do that, we're going to need to be quite ambitious, both in terms of what we want to do to scale, and most importantly, how we're going to do it to scale. This makes it tougher, but I think the upside is greater. And the bigger question that you've posed at the beginning is what we can do to compete with the high-cost credit market, is that we need to be able to provide a realistic and credible vision of what a more inclusive financial system can be. And that will need all of us to come together to do so.
Thanks, thanks for that, Faisal. That's interesting. One thing we'll come back to, and we'll have questions afterwards, but I was interested about how customers are changing. Is that because of the pandemic in the last year, or is there a wider change in different customers?
When I launched Fair Finance in 2005, our customer was pretty straightforward. They were a single mother on benefits. As we grew, we realized that the market of financial exclusion was just much, much bigger. There are a whole different new group of people, caused in part by the various financial crises, the economic changes that we've been through, the changing nature of work, how we engage with financial services provider. We are one small part of a much bigger change that's going on through society. So today at Fair Finance, maybe 20 to 30% of our customers are that first cohort, but increasingly they include people with very thin credit files who've come from different parts of the world, who aren't able to get a foothold in the United Kingdom or get their data reviewed, or they're people who've made a mistake and they found that the previous access to credit has been denied. What connects all of them is that they don't have access to mainstream finance and they don't have rich family members. But in truth, they all have very different needs. Some are wanting to access on the mobile phones, some are online, and some still really want to talk to you in the branch. And I think navigating that complexity alongside the service that you have to provide, which is quicker, faster, more automated, more seamless, is probably one of the biggest challenges that all of us have had to grapple with over the last 15 years.
Yeah, interesting stuff there. Of course, there are all sorts of different customers. I forgot about people new to the country, and I've interviewed plenty who have had exemplary credit records, but the local credit credit score in the UK just doesn't recognise it, so they've got to start all over again. So of course they can't access the mainstream finance. We'll be talking to you more when we have our panel discussion, but I'd like now to talk to Sacha. Sacha, you're going to tell us about yourself and what Fair for All finance fits into this marketplace. And just to remind ourselves that we're talking about people here who can't access mainstream finance and can't access the lowest rates that some of us are privileged enough to get, and so they're having to pay a lot more for the credit. The secret is making sure that they can afford what they pay and that it's a reasonable deal. Sacha, over to you.
Thanks, Simon, and thanks, Faisel. And I think Faisel raised a really important point that, the shape of the marketplace that actually provides credit to people who can't access mainstream credit is shifting phenomenally quickly. So when we first started putting together our business plans for actually really scaling affordable credit, at that point in time, high cost credit was generating about £3 billion worth of originations a year. That market, with the changes that Faisel was referring to, has contracted to about 2 billion. Now, to put it in context, we actually estimate that the actual need in the marketplace is probably about 7 billion. And there is a real gap there in terms of people who actually need access to fair and affordable credit to do everything from getting a washing machine to buying school uniforms to actually being able to have a family holiday. All of those lumpy expenditures that for those of us privileged enough to have a credit card can actually smooth that expenditure. If you can't access this type of credit, you're actually left in a situation where you go without, or you go to high cost, or increasingly the risk that people are actually going to illegal money lenders, which carry massive hazards that go with it. And so I think the interesting thing is this: how do we actually re-envisage what the marketplace looks like? But I think there are some important things that actually anyone wanting to play in this marketplace can learn from, the things that high cost providers actually were very effective at doing, and also learn from some of the things they did that really led us into bad places. So I think the first thing is actually, the high cost providers, I think, became very good at understanding their customers, what their customers wanted, how they wanted to interact, to be able to get speedy access, to be able to get quick decisions, to be able to access things. And this is for those, certainly people who are digitally enabled, that they were, and also to not feel like they were going to a poor person's bank. If you look at Wonga, if you look at Bright House, actually they really create an experience. And I remember talking to a customer, them saying, they made me feel good about myself. I got a glass of champagne when I went into the branch. And so really understanding how people want to feel. They don't want to feel judged. They don't want to feel that they're somehow other. They want to be able to be treated well, respectfully, all of those sorts of things. And I think that's an important aspect in terms of any customer service. And I think, oftentimes we forget that customers, they're not comparing their customer service to another provider of finance. They're providing the service that they're comparing the service to the best customer service they're getting from anyone out there. And so really learning from, what does the best retail experience look like that leaves you feeling that you're valued, that you're important, that they care about you? That is something that certainly at the acquisition stage, some of the high cost providers did really well. And the best affordable credit providers are really good at this too. I think probably the other thing that I think the opportunity is to learn from is actually being really focused in terms of what are the processes that need a human being, and what are the things that actually really could be automated to make your business run much more effectively. And particularly for smaller organizations, that automation, that change journey can be really hard, but actually the route for affordable providers to actually be able to scale and meet demand, to be able to actually drive down your prices so you can actually deliver better value to your customers, comes from being able to run that model really efficiently. The final bit I'll say in terms of learn is learning how to make sure that you're not falling into the trap of believing, and it's interesting, I've talked to a lot of people in the high cost space that a lot of the frontline people believed they were helping their customer because they were helping them get that birthday present. It's not like it was full of nasty people trying to be horrid. They got into that place where they were colluding in believing they were doing something that was good for their customer that was actually bad. And so really being thoughtful that some of the worst pieces across various industries I've been in of where things have gone wrong is because people have fallen over themselves trying to be helpful, which actually has created a really bad outcome in the scenario involved. So those are maybe just the things that I'll sort of leave for us to think about in terms of the exam question, so to speak. So Simon, back to you.
It's interesting you mentioned there Wonga, and I know I spoke to the chief executives and all their senior people loads and loads of times. They simply saw themselves as a technology company, and for their customers, they made it so easy to get money, which was great for convenience. I'm out on a Saturday night, suddenly I haven't got any money, great, use my phone, bang, I've got some. And they did that part really, really, really well. Too well, obviously, because it then encouraged people to get into deeper and deeper debt. So they were a technology company with no moral compass, no responsibility, and that's really why we saw the end of them. But there are strong lessons to be learned from companies like that, aren't there?
Yeah, I think that's right, and I think that's why I think it's really unhelpful when you go into a binary narrative of good and bad. Of actually, there are some brilliant things that organizations do that you can learn from and think, well, how can I use this brilliant thing in a way that really creates good outcomes versus just being a driver for profit? And I think that's a really important thing for us to look at. Customers aren't daft. There are reasons, and there will be really logical reasons why they chose to go with certain customers. And some of that will be down to the experience that they were able to give people. And people weren't stigmatized using that stuff. They felt good about it. And that, I think, is, it's an important part of actually how we think about interacting with people. So we're not going to that Victorian narrative of, oh, we're doing a charitable thing of looking after poor people who otherwise, they're a bit, there is that legacy narrative, which I think we need to be really thoughtful of in serving people who aren't able to access mainstream credit.
I think that's absolutely right, and brings us naturally onto it, if you like, the whole buy now, pay later area, which again is using technology to make things easier for people. Now, surely that's a good thing, Alice? So Alice, you need to unmute yourself.
Hello, everyone. Sorry about that. Yeah, it's really interesting. So I'm gonna sort of shift the focus a little bit away from high cost, as you say. I'm going to share my screen just because, there's a few points that I'd like to sort of talk you through. 1 second. Is that all good? Can everyone see that? Perfect. So yeah, as Theo mentioned at the beginning, I'm a consultant and financial campaigner, which is the experience that I'll be drawing on today to look at what the CDFI sector can learn from buy now, pay later, both in terms of what's gone wrong and also what they've done well. And I think it's really interesting reflecting on Sacha's points, and there are certainly parallels there. I won't give you the full story because it's a long one, but in short, the campaign began on a tube when I saw an advert that looks quite similar to this one on the bus there. And then it culminated earlier this year with the Woolard Review and the FCA's conclusion that buy now, pay later products needed to be regulated. So from June 2020 last year to February this year, lots of stuff happened. We had lots of good press. Stella Creasy backed the campaign. The ASA also produced some guidelines on, how these products could be marketed ethically. But meanwhile, something really interesting was happening, and this is what I want to kind of talk through today as my thoughts as to how this shift happened, which is from the start of the pandemic. Klarna, which is the market leader in the buy now, pay later sector, their UK monthly active users went up over fivefold. And then we saw at Christmas this astonishing statistic that 40% of Christmas shopping was conducted via buy now, pay later, which is pretty staggering. And of course, this is good news for Klarna, albeit with regulation on the horizon. But I think there's a more interesting question here, which is that, overnight this industry has exploded. So, what can we learn from this? Putting the bad practice aside, which we will touch on, they were clearly doing something right. And I've sort of thought about this, particularly through the lens of what CDFIs can learn. And I think there are sort of 5 key points and also one missing ingredient and a bit of a warning as to what we need to be mindful and careful of. And obviously the first one is this lack of regulation, which is, in the name of the campaign, which was regulate buy now, pay later. And for those who don't know, this is largely thanks to the Consumer Credit Act and a single line which says that no interest and relatively short-term credit products do not need to be regulated. And for the likes of Klarna, this meant the ability to kind of present the products in a seemingly risk-free way. And when I would speak to consumers, they'd often be quite confused as to, hold on, this isn't a credit product, is it? This is a payment platform. And there was very little clarity as to what these products actually were. However, the Consumer Credit Act, that was written in 1974. A long time has passed. So I don't necessarily think that regulation is the sole reason for this sort of huge, enormous explosion. I think more interesting is technology and this smooth factor. And this logo here on the left-hand side, this is Klarna's original logo. And then a couple of years ago, they underwent a pretty spectacular rebrand and positioned themselves away from the lender industry and into something quite different. And from the ad on the right, you can really not determine, apart from what it says at the bottom of smooth payments in very small writing, it's very difficult to determine actually what these products are at all. And they're also very fond of their Afghan hounds, which represent the smooth and frictionless nature of these products. And I think that's an important lesson in this, is that actually it's much less to do with use of emerging technology and artificial intelligence and so on. Although they do deploy those successfully, I think it's much more to do with the frictionless nature of these products. And if you've ever used one, you'll know that it is integrated into the customer journey. It's available on impulse at the point of purchase. There is very little scope for a customer to kind of think twice about their purchases. And I think there's certainly lessons to be learned from that. In a positive way. It's super easy to use them. However, there's obviously, and where we saw problems, was that there was perhaps the balance wasn't quite right between frictionless and properly informing and educating consumers at the same time. But nonetheless, I think that slick user journey is a pretty impressive one. Number 3, a third factor is obviously the pandemic. I won't dwell on this one too much. We all know what the pandemic has done for online shopping, and obviously with buy now, pay later so well integrated into the online shopping experience, this makes sense. And I take it this point is perhaps less relevant for those listening, but which takes me on to my 4th point. I think a really interesting trend we've seen is this blurring of the boundaries between and shift really on online and social media meets finance, really. Nowadays, social media is much less about social. It's a bit of a misnomer, really, and much more about shopping and brand experiences and consumption, and increasingly finance as well. And the likes of Klarna have really made the most of this. It's pretty difficult now to tell where you're actually accessing financial products, whether that is via Instagram, for example, whether that's through different platforms. But nonetheless, a lesson that from Klarna is really effective partnerships online, whether that was with retailers or influencers to encourage and promote the use of buy now, pay later. And now in a slightly slightly more maybe responsible guise of using these platforms to communicate and educate around these products and what they are, which I think is a really positive move. Of course, there's bad practice as well, as you see in the bottom right here. This was a ClearPay ad, no money, no problems, which is perhaps not particularly responsible. But other retailers, I worked with ASOS on a best practice on how they could use social media in an ethical and sustainable way to talk about financial products. So I think this is an interesting one, and I think there's good and bad practice, but nonetheless, I think that any lender these days needs to be thinking about how they're using different platforms to communicate and educate and also acquire customers. And finally, the fifth factor, I think, is generational demands. If I had more time, I would sort of do this whistle-stop tour of how to delight Gen Z and millennials, but I'm sure many of you are familiar with some of these themes. Delayed gratification is not something that young people are particularly fond of these days. They're digital natives, cashless, and I think it goes beyond just being cashless. The question isn't how do you want to borrow? That shouldn't really even be a question. It needs to be a thoughtless and seamless and pretty automatic process. And data is obviously comes into this, being willing to provide data, even biometric data, to improve your experience. However, it's vital that the giving of that data is worth it. And the reasoning for it is made clear. And finally, just to wrap up, I know I've sort of painted a picture that follow the trajectory of the likes of Klarna. It's a great thing, find an unregulated market. But of course, Klarna are now facing regulation and things are changing for them. But I think there is one key ingredient that the buy now, pay later sector have really overlooked and entirely forgotten about, and was really the reasoning behind our campaign. And it's something that I think is more important than ever, as Sacha touched on. This is probably responsible for the demise of entire companies such as Wonga, and that is sustainability. And I mean this in the sort of broadest sense, both a business model that can survive regulation and backlash and scale. And there are still certainly questions as to whether buy now, pay later ticks that sustainability box. For the planet, of course, long term, I think we will see a future which is pretty incompatible with businesses that promote unsustainable choices. And finally, and most importantly, I think, is for customers, providing sustainable financial choices and doing the right thing, which, it often doing that comes at the cost of scale, and more isn't always better. And in terms of lending decisions, I think that is more important than ever. So yeah, that's me. I hope that was helpful and insightful, and looking forward to hearing what the other speakers have to say on this.
Alice, thank you for that. That was fascinating. Quick, direct question. Will the buy now, pay later lenders survive regulation?
Oh, the big one. I think the big question at the moment is what the regulation looks like, and that's something that that isn't necessarily clear. My sort of gut feeling on it at the moment is yes, and hope actually is that it does, because I think these products can be really useful for some consumers and they can be used well. I think the key question is maybe competition. The market is becoming increasingly crowded, so will some of the smaller players survive? That'll be an interesting one.
Yeah, well, we'll see. I'm like a lot of different debt and lenders, I'm not sure how much there's a need for this and whether they're creating debt, but there we go. We'll probably talk about this further when we have our discussion. I want to move on, if we may now, to Jason Wassell. He's Chief Executive of the Consumer Credit Trade Association. Well, I'm not quite sure what that is, but I know he was also the head of the Consumer Finance Association, which I used to know well, which is basically the trade association for the high cost credit industry, amongst others. So I'm sure he's got lots of insights actually to help us looking forward. Is that true, Jason?
It is, yes. I was Chief Executive of the Consumer Finance Association. Many of the names already mentioned I represented in the past. I'll start by saying hello from sunny Kilmarnock on the edge of Glasgow. Delighted to be here. Yes, I represent high-cost credit firms alongside a range of non-bank lenders. And so I'm probably I'm holding out for being the most unexpected panelist on this particular session, which is about tackling and competing with high-cost credit providers. But let me come back to that as I close my introduction. I'm sure that not many people have heard of me, not many people have heard of the CCTA in this particular audience. So I'll take a couple of minutes just to talk about myself, my background in the CCTA. As mentioned, professionally, I come from a campaigns and communication background. And more recently is now become a decade ago, I moved from risk into consumer credit. Go back far enough and I was involved in the public sector, both national health and local government. And it was through that I got involved in campaigns. Specifically, one of my earlier campaigns was a Scottish campaign, One Scotland, Many Cultures, an anti-racism campaign, which became a pioneering government campaign. I've worked on other things across the UK as a consultant, tackling homelessness, fuel poverty, social housing, promoting these things. And briefly, I worked internationally on tackling domestic violence. And I worked in the Middle East on honor killings and how honor killings can be tackled by government and by communities coming together. So I think that's a rather kind of strange and unusual background for somebody that's now representing high cost credit. But I think that I've always had a sense of mission, and that's why I'm here. My work with UK and Scottish government brought me into risk, in particular national risk, and I was involved in planning for pandemics, for terrorism, for fuel poverty, for fuel strikes, and for utility failure. And that's some people might say, well, that was good training for coming into consumer credit. But I've been in consumer credit for about a decade. I have been a lender, but I've also been involved in trade associations. And therefore, at the beginning of this year, I was asked to join the Consumer Credit Trade Association as their chief executive. The CCTA is an association of alternative lenders. It's been around for 130 years. We define alternative as those providing non-mainstream products or serving non-mainstream customers, or even those of alternative business models as well. We have 190 members. They range from small lenders providing niche credit to larger lenders and high cost credit. We've already talked about Provident. And I would say, just for transparency, Provident is not one of my members. I do not represent Provident. I do represent their competitors, the ones that will want to seek to step in and provide very similar products to the one that Provident provides. And I would kind of on Provident's behalf kind of say they've been very successful, not through exploitation, but by meeting customers' needs. And I think by finding a product that has a seasonality to it, yes, birthdays may be one part of that, but I think paying for Christmas is something that is for a certain part of the population is very difficult, and Provident kind of pop in to kind of work on that and to meet that particular need. And it is about meeting those needs, and they've been around for 140 years meeting that need. But whilst we're positioned as talking about competition, and whilst we're positioned as opponents, high cost versus CDFIs, I would probably close my introduction by pointing to a couple of areas where we may agree. And first, that lending decisions at the lower end of credit scores are some of the most difficult to make. We don't have the luxury of perfect information or the stability that comes from prime customers. And these decisions, these calculations that you and we make are some of the most difficult, because we are trying to calculate down to pounds and pence and trying to work out whether that's affordable and whether that person is credit worthy. And those are difficult decisions to make. And let me be a little bit more controversial for my second point. And I make clear that this isn't the view of the CCTA, it's my personal view, but I don't think the market works. I don't think it works well at all for large parts of the population. There are obviously parts of the population that are ignored by this market. There is an obsession with chasing prime customers. And so outside of the prime, there are fewer options and sometimes no options at all. And that's why I'm happy to be here today, talking about how we take on high cost credit, because we have to work with organizations that want to create more opportunities for consumer credit. And so I'll kind of leave my introduction there, but I look forward to answering some of the questions and possibly bringing a slightly different angle to some of the answers.
You mentioned prime and subprime, and the subprime market is always a difficult one because these are often vulnerable people. It's not just that they've been excluded from mainstream. There could be other problems going on. So we know we need to treat them responsibly. Is it not right that any lender in the subprime space should be working towards taking their customers towards the prime space as far as possible?
Love to. Would love to do that. Would like to see our products as a stepping stone to the prime. Would absolutely love to do that. But that's not how our system works. It's not how our credit file system works. People taking out subprime credit products don't get the positive kind of change to the credit file that they should have once they've paid back those kind of subprime products. As they move into near prime, they should be able to pay those back. That performance should count. It doesn't. It doesn't count. So we would love to be part of that process, but the system at the moment doesn't allow us, and it's something that we campaign on regularly. So
how do we need to change the system to let that happen?
Well, one thing is, it's bigger than that, isn't it? It's kind of, then we have to kind of, with an obsession with the prime, the tasks becomes, how do we kick people out of that group? How do we identify people as not being in the prime? And that's where we look. Well, that's where more information is then used to kind of say, well, these people are not in the prime. They're in near prime, subprime. We need to find ways in which we convince prime lenders to take a chance. That's one thing. But we also need to talk about how we improve the credit system, the credit file system, the credit reporting, so that people do get the credit that they deserve from good performance.
I mean, you're absolutely right. It's going to be really hard to persuade mainstream lenders to take on even near prime customers, let alone subprime customers, because of the risks. And it's understandable, they've got their shareholders to, call the tunes. They don't want to take too much risks with their money. But if we could get to a system where there was some kind of roadmap, and with the mainstream lenders playing ball with that, then that would be great. But that's one for another day, really. Today, we're going to be talking about how community lenders can compete with high cost credit. I'm going to come back to you first, Jason, on this first question, to be honest. So the whole sector currently lends 25 to 30 million, which is a tiny, tiny drop in the ocean. There's 35,000 consumers using that. Now, we did mention earlier, Provident had 350,000 consumers. Presumably, any of their customers could be part of the CDFI sector. So how do we get that demographic to move across to responsible finance members? Now, Jason, with your background with these kind of lenders, what's there to be learned from that sector that responsible finance companies can take on board?
I think you start with a really valuable statistic there, which is about 350,000 customers. I think the reality is there's probably 400, 500,000 people that you would consider to be in Provident's market, and that may consider using Provident. They kind of come in and go out, but that's a huge number, and it's 400,000 people that have lost the lender that they trust and rely on. Now, we can have a conversation, a debate about that reliance and where that becomes a difficulty and where that is just meeting a need. But in many communities around the country, and I think we've talked about this already, they were one of the few options, if not the only option, in terms of borrowing. And I think that's something that's only going to be worse with the pandemic and the impacts of that. And I think, Simon, you mention what I always say, which is anyone expecting the banks to step in and to deal with this hasn't read their history books. There is a reason why we exist. My organization is 130 years old. It was created by the organizations that introduced hire purchase. 130 years ago, we introduced the concept of hire purchase, and this organization, I think, was called the Protective Hire Purchase Association or something like that. But that's where we come from, is from an understanding that banks don't provide and that somebody else has to step in. In terms of stepping up, I think we're going to come back to this time and time again through the session, in that the the building blocks of lending are no different from CDFIs to commercial lenders. It's about identifying that need. It's about finding ways to acquire customers. It's making good lending decisions. It's collecting the money, and it's being ready to help when things go wrong. And I think that, those are the things we're going to come back to time and time during this question. I would kind of say that we should probably try and learn the lessons of Provident and not just assume that it's a bad organization and that's why it's withdrawn or that's why it's gone bad. There are things here about the change in regulation. There are changes here in demographics. There are a bundle of things that we need to think about and look at. And I don't think you can just kind of celebrate the departure of Provident and think that's a good thing without looking at why it broke down. And there are many reasons for that. I suggest there's a lesson in Provident around shifts in regulatory interpretation. In this case, questions around affordability. Within my world, you can't move without talking about affordability. It's a massive issue. It's an issue that I talk about at nearly every meeting of my association, every sub-meeting. Even if it was about something else, affordability still comes up. There's a massive amount of work being done by our sector on this. There's some really interesting, exciting developments around dynamics of affordability and how affordability can be more dynamic. And I think that the way that we do this is by talking together. So my kind of call is for, CDFIs and, my members, we should be talking together. We should be sharing and kind of thinking more about what do we know about customers? What do we know about the elements of lending, and how can we kind of share that best practice together?
Yeah, interesting stuff. Alice, I'm going to come to you next, but before I do, thank you to those of you who put in some questions. Do please add your questions to the Q&A. There's a little Q&A button at the bottom. Hold on. So that's, I don't know, on that side, I think. And if you just click on that and it comes up, put your question. And after we've had our panel discussion, we'll be taking your questions. So I'm looking forward to seeing them. Alice, you just heard what Jason said. What's your comment on that?
Yeah, it's been a really interesting learning experience for me, actually. I started the campaign with actually, nowhere near the level of expertise as particularly in the lending sector as those on this panel. And it's been a really interesting journey of acknowledging, as Jason says, that there is a balance between meeting needs and also responsibility and affordability. And I think with the likes of the buy now, pay later, which is serving an entirely different market, I think in some ways the problem is similar in that we saw very little in the way of affordability consciousness, I suppose, and really capitalizing on a loophole in regulation. But that isn't to say that those products aren't also meeting a need. And I think the other side of it, which sort of slightly off topic, but something I sort of came to notice, was that when I was engaging with some of these the buy now pay later lenders, and actually other lenders as well, they would talk about sort of throw statistics around it and say that, well, they are responsible because, their default rate is only this much, or they, sort of various comments on how it was ethical lending and it was responsible. But I think the question is always, it's not necessarily just about the majority. Actually the role of regulation and the role of having conversations like this is to protect the minority. In some cases, with the buy now, pay later debate, that was about, often it would be sort of very, very young consumers with poor financial literacy and maybe, mental health challenges and things like that. But I think that question is the same, is that it's not necessarily about the majority of consumers. I think it's also focusing on the minority that might not being served particularly well or treated so well.
And you mentioned that the buy now, pay later lenders, are they meeting a need or creating a need?
Yeah, that's a really interesting one. I think they have created, just looking at those stats of the explosion of the industry, and also they've not just been, turning consumers away from, say, credit cards. They are now the first point of interaction with credit for many young consumers. So they have, to a degree, created a need. However, I would also say for those that, you know, are able to access these products, given that most of the time they are 0%, that is arguably a better alternative to credit cards, for example. So there is a need, but the question for me has always been about how they are communicated, who they're serving, and ensuring that the information is present, which obviously when you're unregulated, and particularly with buy now, pay later, there simply wasn't the instruction to include risk wording, to talk about what these products actually were. So that's the challenge for me.
Okay, interesting. Faisel, I'm going to turn to you now. We'll go back to the sort of the essence of the question. So you've had 15 years experience in this space now. What actually needs to happen so community lenders can be a viable, sustainable alternative?
It's a pretty massive question. And for sure, after 15 years, I can tell you what needs to happen, but there's a massive challenge of, I suppose, the bigger question of why it's not happening. I think the first part is, it's become really relevant to have this conversation in the light of what you said prior regarding Provident. We have a kind of a clear and present impact of the largest lender who's been around for 150 years, suddenly exiting the market, and nearly 500,000 people unable to access finance in a way that they've been able to before. And I think it raises the question much bigger than it ever has been. But the answers are still the same. The community finance sector itself is, excuse me, I have a dog that's seemingly attacking my foot. Just give me a second. The community finance sector itself has had a massive challenge in terms of trying to find a way of, I'll tell you what, can I just come back in 1 second?
Yeah, you go ahead and shoot the dog. Let's ask Sacha to come in here. There's some, it is a big question, and I know you haven't got a simple answer, but I know you've got some interesting views.
Yeah, I think that there are a number of things, and it goes to the heart of why we were set up in the first place, of recognizing that actually there are some brilliant community finance providers who are actually very close to their customers, but actually the challenge is that actually lending relatively small amounts of credit is something that needs to be done at scale. Otherwise, from business perspective, it makes it really challenging for that to be a sustainable model. Frankly, your costs outweigh the income that you can get from generating, the interest income that you can generate. And that sort of, that thing of, well, how do I get a business to scale, goes into, requires investment. It requires long-term patient capital to actually help you to do that. And, I think one of the key things that really was behind our setup was recognizing that the community finance sector wasn't set up to have access to that kind of long-term patient capital. So many of the financing structures were ones that you would never have put in place in the commercial sector if you wanted a business to be able to scale and grow. And I think the other thing is that the market is very fragmented, which then also means that in terms of actually delivering investment and support, often it gets split across far too many organisations, and therefore you're not actually getting that real impact from the investment. And so that's something that we've really sort of tried to address. Is one is, how we can get some long-term patient capital into organizations, but the other is to be able to look at some of the capacity building in the sector, to be able to say, well, actually all of us need to be able to understand how to build awareness and do this effectively, and no, it does not need to be bespoke to every single organization. And if you can take that mindset, then actually you can start to do some things that really transform how you actually can deliver services. And I think, also having that open-minded mindset to, where we started, well, what can we learn from what high-cost providers did well? Because, that's going to be the key to actually having efficient business models that can meet demand and can really, set up organizations to be able to, maintain their mission as they scale, to actually deliver into the marketplace. But I think that fundamental, that lack of capital and that fragmentation of the market, I think, have been two of the really key challenges to community finance scaling to date.
Okay, well, that's interesting. I mean, you know, there's obviously a lot of good things to be learned from the likes of Provident, from the buy now, pay later lenders, from Wonga, you know, which all had good, some good business practices despite what else was happening. Faisel, have you got rid of your dog? Are you able to talk to us now?
Sorry about that. Some perils of working from home. I have, and maybe I can pick up from there. Actually, I think Sacha's picked out one of the biggest point, the fundamental point about how do you finance and resource an alternative to be scalable and credible. But if I could just add to the other areas that I think are really important. The first is around technology, and the second is around the route to market. There's a phrase that's often used in international development and microfinance, which is one of the reasons why people are financially excluded is because the last mile is the most expensive and the hardest to get there. How do you get into the villages and communities, the small towns and areas where bank branches just don't exist or people don't? And I think until we can find a way to address that sustainably, the cost of getting to that last mile is usually prohibitively expensive. Many community organizations start in that last mile. So it's quite easy to see how to deal with the problem in that community. It's quite hard to replicate that in other communities. And so one of the things that we may want to think about and embracing here is around how do we go from the last mile to the last inch? How do we get to the mobile phone, the smartphone, the technology that's in everybody's pockets? It's ubiquitous across the board. At Fair Finance, 90% of our customers access our website on a mobile. So we know that if we were able to do that effectively, we'd be getting to most of the people. So I think that's the first biggest challenge. It's not so much how do we get into every community by replicating our model, it's how do we get as close to all those communities as possible in the most cost-effective way that we haven't been able to do previously. The second then becomes around technology. So technology in two forms. One is many of the community lenders have started from a branch-based service. And so by doing that, it allowed us to gain insight, market intelligence, whatever you want to call it, a kind of an understanding of who the customer was and how that customer engaged with us. And it allowed us to iteratively keep developing and improving our service at a very local level for those people. The truth is you can't do that when your customers are 10, 20, 30, 40, 50, 60,000. You can't capture all of the information you need. And for many organizations, you know, myself included, we never prioritized technology and data capture. And because of that, we're lacking to get to the place where, you know, one, it needs to be a massive part of our business, and two, how are we going to analyze and use it? But the second part of that technology and data capture side is how do we create a cost-effective business that can deal with the demand that's out there? If the 300 to 400,000 customers of the Provident came to Fair Finance tomorrow, we'd probably collapse. In fact, if they came to the entire sector would collapse. It doesn't have the institutional capacity, the technology, the framework that would allow it to develop. Now, all of those are things that we've talked about for many years: insight, technology, funding, routes to market. But I think now we're in a position where we have really great insights that you can automate many of these things. You can capture that information, you can analyze it, and we can find potentially that funder. The bit that's missing is how do we replicate the engagement that's worked really well? And I think this touches really closely to some of the things that we've seen scaling in the payday and the buy now pay later market, which is you can grow very quickly if you don't really care about the impact and the engagement that you have with your customer. You can grow really quickly if you want to be irresponsible about the questions that you ask them. And I prefer a phrase that we often use at Fair Finance, which is around how do you introduce what we might call positive frictions in the process? Positive frictions, by any other word, could be called advice. When you get a loan at Fair Finance in the branch, you're not going to get it in five seconds. You're going to have to speak to somebody. Now, clearly, you can't replicate that engagement online, but a lot of that online engagement is inadvertently impacting the way that you behave, what you do, how you do it. We can change the way that we think our services can be translated online by rethinking our engagement with our customers online and at scale. And the only way we can do that is by research. We did a piece of research at Fair Finance to encourage, how do we encourage affordable borrowing? And we found that if we set our online sliders at 0 versus 500, we could change what people were borrowing. Now, on the face of it, why should something so innocuous and kind of irrelevant make an impact? But it does. And I think if we navigate to start providing our services at scale online to more people, we need to manage the process of engagement and realize that at every single juncture, we impact our customer choice. And by researching that effectively, we can encourage that choice to be positive outcomes that could be the equivalent of the advice that we might have given in our branches. So I think that's a really, really big and important area that, we can scale the technology, we can grow the funding, we can scale our businesses in marketing. But until we've figured out how to do it in a responsible way, we may end up inadvertently falling down the same problems that others have had.
That sounds quite scary, to be honest. But there's all good points. There are huge barriers to making this happen. I like your idea of the last mile and your recognition that actually in that last mile there are little local lenders of different kinds. It strikes me, obviously, if maybe we could get all those little lenders to be talking to each other and there's an overarching, bigger lender, maybe it might be some consumer association. What do you reckon, Jason?
I think I should tear my meat off. I think you're talking about lenders all the time. I think one of the things that we have in our world is that we're part of an ecosystem. The lenders are just a small part of that ecosystem. If I wanted to return to being a lender next week, then like many of you, I could have a model set up very, very quickly in my mind. I would have to go out and get investment. That would be an absolute nightmare at the moment, but I could bring together the nuts and bolts very quickly. I would have an ecosystem around me, which is not the lending part. It's all the elements of the lending. It's about the customer acquisition. I could find somebody to help me with my customer acquisition. I could have someone create a decision-making model that works for my customers. I could have a loan servicing company. I could have a payment service. I could have other companies that could help me if things go wrong in terms of debt collection and debt purchase and debt sale. But that's all because there's an ecosystem there. It's not about lenders speaking to each other. It's about vendors, suppliers, investors, the leaders of tomorrow, the leaders of your section of tomorrow, the leader of your sector. It's about them all kind of being part of an ecosystem rather than just thinking it's one lender speaking to another lender and sharing. As I said, I think it's more about then how do you create that? Well, that's about aligning your interests to the interests of others. And aligning your interests to the interests of those in the ecosystem, which is about lending money. It's not about financial inclusion or reducing indebtedness. It's about lending money. And in that way, you create an ecosystem in which other people can help you and you can kind of do that. And if you want to focus on that last mile or that last millimeter, you can, but you've got other people to do a lot of the other work. And I think that's what may be missing. I don't know your sector incredibly well, but I just know that that's our sector. Our sector isn't lenders. It is an ecosystem of lenders, advisors, investors, and various other organizations. And that's what you need to create. So it's not an association of lenders. It's an association of everybody involved in lending.
Yeah, well, and that's obviously quite important because you need all these different bodies. Sacha, I want to come to you and then to you, Alice, to give me your thoughts on this. Sacha?
Yeah, I agree. I think that ecosystem point, I think, is absolutely right because, one of the, it's such a big topic. But we know that actually nurturing providers who will provide lending capital into organizations that are actually lending to this customer group, that's a gap and a challenge. And we're working on that to actually create an affordable credit debt fund, rolls off the tongue, to actually sort of allow providers to actually get access to that capital to scale and grow. So and similarly, we're doing a lot of work in terms of tech providers around how do we make sure that everything that Faisel was talked about, how do we make sure that we've got providers that are reliable, that are resilient, providing best in class technology, actually serving this sector. I think the debt collection side is a really interesting one. I think there could be a real argument for an ethical debt collection practice to actually really sort of support affordable lending. So, and I think all of those things do need to be looked at. And I think this is the opportunity and challenge, because I think that in some ways what we've got at the moment are microsystems that are existing around lots of individual organizations, rather than it being drawn together in terms of one big ecosystem where there is that alignment of purpose around actually we want to make sure that collectively we are delivering to people who otherwise wouldn't have access to credit. And I think that's part of the conversation a lot of the work that we're doing with providers is actually starting to unlock some of that stuff. And, it helps having a bit of funding to be able to do that, to be honest, because, and to be able to bring people together at scale, because we know that, if you come to providers and building that ecosystem, if you're one small organization that isn't going to be that big a deal to people, it's much harder to exercise buying power than if you've actually got a collection of people coming together. And it's why organizations like Responsible Finance, trade bodies are so important in that ecosystem building, if you like.
Yeah. I'm getting a bit of a headache now trying to think about all these different problems which we've got to boil down. I'm hoping Alice has some wonderful insights for us.
Yeah, I think the last thing I'd really like to just reflect was actually just building on one of the points that Faisel made about positive frictions. My academic background is behavioral economics, so I geek out about this kind of nudge theory and things like that. But I think it's such an important point, and certainly to go back to sort of my side of buy now pay later and what we've seen there, I think the difficult thing is that often technology and our data and our behavioral biases are often actually weaponized against us to make poor decisions. We've seen this with in the case of e-commerce and buy now pay later, it's that your data is either used in sort of dynamic pricing or just little nudges, like the fact if it's a red button, you're more likely to check out and things like that. And so I think there's a real responsibility to start using data and start using behavioral insights to push positive choices and responsible decision making as well. And also in positive frictions, I think that includes good quality information and education, and on that ecosystem point as well. I think that's a really interesting idea of bringing all of these different lenders together so that consumers are able to make better decisions by being presented with all their options, as opposed to necessarily it being quite so segmented.
Yeah, I mean, the problem clearly then is we've got the technology. This is all here, there, now. We can make this happen. We've got the data. It's persuading lenders to be responsible about it and take the right approach. Now, Sacha, you were nodding enthusiastically then while Alice was talking. What would you like to add?
I think it's just violent agreement. I think that whole idea of this real danger that there's a lot of stuff that hear about in terms of providing free choice, and actually no, it's manipulating people based on understanding their vulnerabilities, and there's far too much of that is built into, actually not just into the credit sector, but actually in terms of broader retail, etc., around how people are effectively manipulated to buy stuff they don't need to generate profit for businesses, and a whole sort of collusion across the system around that, which frankly is unsustainable for individuals and unsustainable for our planet. So that's probably a bit beyond the scope of this conversation, but I just really agree with Alice on that there is a lot of manipulation that is going on under the guise of free choice.
And I think we've always seen that with lenders, particularly in the high cost credit space manipulation. They are manipulating borrowers because they want to make money out of them. That's their, the whole whys and wherefores of them. Let's move on. We're going to do this panel for about another 10 minutes, and then we're going to take your Q&A. So if you do have any more questions, do put them in now so we can get to them in about 10 minutes. The next question that I wanted us to address was this. I'm going to read this out. The scaling up of community lenders is part of a policy solution to reduce over-indebtedness. How does it become the right market solution as well? Which means, how do we both validate credit as a fair choice for low-income households, as well as making it visible to them? Let's go to you, Jason, for that.
I think you've probably come to the wrong person for this. I mean, I as a friendly outsider, I think that your link to being a policy solution is another barrier, it's another obstacle. It doesn't help you at all. If I was developing a strategy for your sector, of course, I couldn't ignore the advantages that come from your association with tackling over indebtedness. I'm sure you would welcome the support that comes from that. But of course, it brings its own problems. First of all, it brings you into an alliance with organizations that may not be fully aligned with the idea of a growth of credit. They may believe that credit is wrong. As I've heard here, credit may only be available to certain customers. We know best when credit should be used, and that might come through. Or maybe they believe that it's not about credit, that this could be there could be other political interventions that kind of an increasing wealth distribution or higher levels of support. My personal politics is down that line, to be honest. And talking of politics, secondly, you become a political initiative, a project financed by politicians, mentioned by politicians whenever you can, often relying on the whims of politicians. And how often do political projects actually succeed, particularly those that need to have commercial decisions as well? And you're grouped in with other initiatives. We talk about you in our sector as we talk about no interest loans. The idea that you can have a scheme where you are lending to with some of the highest overheads per pound borrowed or per pound lent, as Sacha mentioned. And also, she didn't mention this, but also to some of the most riskiest customers and not charge interest. That's balmy. And yet CDFIs are kind of linked into that kind of scheme as well. And thirdly, you become part of a solution that's taking its time to show results and costing a lot of money, and not commercial money, but taxpayers' money as well. Every year we hear more and more about scaling up. You'll be delighted to hear whenever I meet with a minister, which is very infrequent, just before anybody asks about lobbying. But whenever I've spoken to him, he's made clear to me that he's spending money on alternatives to my lenders, the lenders that pay my salary. But progress seems very slow, hugely expensive, and with more false starts than I probably would hope to see. And so you kind of say, well, why is this a barrier? What's the problem with this? Well, I think your key objective, and it goes back to that ecosystem, has to be about bringing people in that are committed to the sector, that want to spend their time, their research budget, their finance in this, investors, suppliers, advisors, future leaders. And the perception is so important. And I think that's your problem. That's your first problem. I'm not sure how you get away from it unless you kind of move away from being so associated with being a policy solution. So I'll give you that advice as a friendly outsider.
That's great advice. I presume you would deny receiving a text from David Cameron, but I won't expect you to.
No, only employer advance schemes, which of course you all here on this absolutely believe should replace payday lending. So you've all opted for a scheme, for an initiative, for a product that's not regulated, doesn't have affordability, doesn't use forbearance, always gets paid, always gets paid of priority debts. That's the people on this call, not me. I'm not involved in that kind of tomfoolery, I've got to say.
We do have a question from the audience about that, but Faisel, I want to ask you, would you embrace political intervention?
I have to admit, I'm going to admit to agreeing with some of what Jason has mentioned earlier. Not all, but some. But what I would agree with is that when I started this work, the work of addressing the issues of high cost credit exploitation, financial exploitation was a real and live one. We had very little regulation or control on the payday, doorstep or high cost lending market. And to be frank, from the early noughties till about the 2015s, this work was as much a campaign as it was anything else. So I think, very much like the buy now, pay later movement at that time, we were drawing attention to the fact that there was not enough regulation, lots of bad practice, and lots of exploitation happening in a market that people didn't really understand, didn't really think about, and didn't really know what the solutions were. And because of that, lots of the interventions were, I would say, perhaps aligned more to people's ethics and morals as opposed to understanding what the real problem was, which is how do you bring sustainable, affordable, responsible finance to people who need it? Not for Nike shoes and flat screen televisions, but for basics. that part of the moralizing about what people need money for is probably what has held back a lot of the development in this sector and maybe driven how some of the funding has been created. One of the things I did at Fair Finance was very early on, we decided to walk down a path of not using government money to scale. We tried to raise commercial money, social investment, and more mission-aligned funding that would allow us to focus on the customer. And that's allowed us to do a lot more. And I would say that the more of that we can have, the more we can focus on our customers. Because since 2015, the campaign has moved. We no longer need to campaign for an affordable, responsible lending practice. We no longer need to campaign for responsible debt collection practices. We no longer need to talk about how the CPAs were taking advantage of people. All of that's changed. We now need to prove, really, in relation to the previous question we were talking about, what does this new industry look like? And we don't know that yet because we haven't had a chance to do so. We haven't had a chance to compete on a fair and even keel with access to finance, access to insights, and all of the other things that will allow us to grow. It is really important that we do it properly, but it is really important that we do it from the focus of the customer first and the services that they need. So I think in that sense, I'll agree with you, Jason, but on the other sense, I would disagree, because I don't think the sector defines itself by that. I think the sector defines itself by wanting to serve this need, and we haven't had the tools in order to do so.
Yeah. So what, Sacha, I mean, I presume you're more likely to agree with Faisal than Jason. What are the tools that we need to make this happen?
I think that there is something here which is actually sort of saying, you know, to actually create that systemic change, that there is some sort of catalytic sort of activities that can actually help us move towards a sustainable market. I think that there does need to be this coalescence actually between regulators, between mainstream finance, between community finance lenders, between high cost of actually of customers who may not have a great credit rating, et cetera, to actually really get that sort of clarity of vision and what is the part that different people actually want to play in the system. So I think that is an important element. Then also just being able to, you know, looking at where organizations are now and where they want to be, what are things that are actually going to help flip the dial. So it's, you know, when we're looking at things like financing of community finance providers, for example, you know, oftentimes mainstream financial institutions providing lines of debt capital, they're like, well, they're a bit small for us to get out of bed for. Customer base is a bit risky. We're a bit nervous about going near subprime anyway, and there isn't, you know, we're not sure these businesses can lend sustainably. And so, you know, to a certain extent, it's actually being able to say, right, well, what are things that we can do that can actually systematically, you know, address those issues and create the space for organizations to scale and grow. So I think some of that sort of transformational stuff, I think, is really important. I think the other thing that I'll sneak in here, because I think it is important, is that with the changes in the dynamic and the shortfalls in provision, you know, there is the risk that you have illegal money lenders stepping in. And, you know, there's some really interesting stuff in terms of research from other countries that where, you know, the regulated provision has dropped very quickly, is that actually the, you know, unregulated lending steps in. And that's not how we think about it these days. Organized crime, or OCGs, for anyone who's been watching Line of Duty, you know, they're really smart now. Their sites will look smart, beautiful, and often are actually enabled by big tech, as in Google, Facebook, etc., to actually find their routes to customers. So, you know, being able to sort of be alert to that and think about, you know, what is the role of big tech in making sure that people are actually being made aware of the, you know, of organizations that are actually appropriate, and you're not finding that, you know, organized crime effectively are getting to people. And that's been a massive issue in places like Japan, certain places in the States, where they've seen this market dynamic. Things have shifted very, very quickly. So I think there is something there of this real hazard for us to watch out for. And at the moment, I don't think the big tech providers are particularly helpful on that. They'll promote who is paying them the most, and that's a really unhelpful dynamic.
I think that really is an unhelpful dynamic. I'm not a watcher of Line of Duty, but I understand the phrase organised crime. Now, does that mean that buy now, pay later lenders, unregulated lenders, are they part of the organised criminal network, Alice?
I hope no one from Klarna is listening. No, I think that's going a little bit far. I do love Line of Duty though. So no, I mean, I think, and that's something that Faisal was saying about this, the moralization of, you know, what people spend the money on. I think that's a really important point, and it's a fine line to, you know, to be conscious of talking about, you know, how you protect consumers, and without kind of being too principled about, you know, how to do so whilst also giving people freedom of choice and so on. But no, I don't see, I really don't see sort of buy now, pay later as all inherently bad. And actually, since launching the campaign, a lot has happened, and I think actually that's testament and a demonstration of how things can change in sectors fairly quickly, since kind of calling out a lot of bad practice. I mean, certainly not just me, but just more broadly, and conversations with providers. I think they have already taken steps to address issues like affordability, and also starting to look at, you know, better measures of affordability, whether that's using open banking, for example, which is another interesting use of technology. So things have changed. There's still bad practice out there, and I also, you know, perhaps do disagree slightly in pushing people into buying products that they don't need. But I think it's a grey area.
I have to agree. Listen, time's moving on, and we have got some questions from our audience, so I would like the panel to address that, if we may. First question, which is something I'm fascinated about, is the things such as partners, visas. These are the cultural lenders, if you like. When I did a TV program, I was amazed that they had this network of, if you like, family and friends, and they trust each other with their money, and it works beautifully well. So the question though is, what value do you see in supporting and resourcing these long-standing initiatives? Let's put that to Sacha.
Hi, thank you. I think it's a really important and under-researched area, actually, and we are shortly going out to procure some research to really understand. You know, we know that the outcomes for people from certain minority ethnic backgrounds in terms of financial exclusion are significantly worse than their white counterparts, and there's been, you know, really good research by the Runnymede Trust that has evidenced that. The next step, sort of follow on from that, is to understand, well, specifically how differently would you design the financial system where there are issues and barriers that are actually built into the system. And that's partly from understanding, right, well, what is working well in terms of groups, and what can we learn from them, and what can we learn in terms of helping them to scale, but also what might be things that are designed into systems. For example, you know, we know that postcodes in terms of insurance, that can actually bake in significant inequality for particular groups. So our research is to really look at both of those aspects, and to then from that to really look at, right, well, having learnt what works really well, what else can we do so that they're very much, you know, in a holistic part of the solution rather than seen as something other over there. And I think that's really important.
So I should have thanked Annika Diva for that question. That was really interesting. For those who don't know, these systems work by essentially a group of people handing cash over to a trusted person, and then when someone has a need for money, they get the money. Now it seems far too simple to work, but it does. Let's have a look at another question while we're running out of time a bit. I'm going to put this one to Faisal, and it's something that Jason touched upon. Scarlett Brown asks, where do you stand on the in-work lending offerings that seem to be growing and that do salary advance or salary-based loans? Are they solutions we should celebrate?
I think there are two parts to this answer. One is that anything that allows people to get access to better and more affordable finance should be celebrated as part of a broader mix of financial products and services that people can get. I do worry that there is a lack of regulation around this product and this service. We don't really know whether they have to do the same levels of affordability checks or whether they need to be lending in the context of the wider borrowing base of the individuals. So from my perspective, I think it's an interesting one, and one that should be supported to learn more about, but there are still quite a lot of unanswered questions about what controls, what protections borrowers have when they use this.
I absolutely agree. Again, it's a simple solution, but we do need more clarity and regulation. Our next question I'm going to put to Alice, it's about sort of regulation compensation. From Philip Carey asks, would you agree the big challenge to new entrants disrupting the high cost lending space is the lack of clarity from the FCA, the City Watchdog, around re-lending and the risk of FOS and consumer compensation?
I can't speak specifically to high cost because that's certainly that's for Jason to tackle. But certainly my experience and one of the challenges with the sector I've been focused on, and I think salary finance is similar, is the slow moving nature. I think it's perhaps a little cynical to sort of put it on the FCA as they just sort of don't provide clarity, but I think it's largely been down to the inability of them to sort of catch up and keep up with technology and stay conscious, I guess, of what's happening in the market. Is that happening with high cost? I'm not entirely sure, but I'd imagine that perhaps that is the case. And one of the big pushes on my side, I guess, beyond the campaigning work that I've been doing is calling on the FCA to, I guess, stay more relevant and up to speed with what is happening, both in what should be regulated markets and also, as Sacha was talking about, in the criminal activity as well. And also, I should add, sorry, the other big one, which is sort of very, very off topic, but also around investment scams and going back to what I was saying earlier, what's happening on social media. And I think that's a pretty alarming lack of action.
Well, I have to agree with you there. Investment scams, in fact, all these scams that are happening is terrible. Jason, you're ready for this ball to be passed over to you?
Yeah, the discussion point, the focus of my life for the last 3 years. I don't blame, I don't blame FOS, I don't blame the FCA. I do think the structure we have, the regulatory structure at the moment, has some flaws in it. And I think in particularly the principles-based approach that we've moved to in years kind of puts us in a difficult position. It puts all lenders in a difficult position. It's one of the subjects that we should be talking about as a group. It shouldn't be about us versus you and having that debate. There should be a discussion about, and I think Sacha mentioned it, like, how do we all work together? Where do we fit? And in this, there's a kind of discussion about the impact of principles-based regulation. So on things like affordability, you can have a discussion 5 years ago, 6 years ago, like we may have done with the FCA about principles. A principle might be you should lend sustainably. Okay, fine. What does that mean? And we might have had a discussion at the time about what that meant, but nothing was written down. It was that principle came into effect. A few years later, that principle was then looked at again and reinterpreted, sometimes by the supervisors within the FCA, sometimes by FOS. And now we've got a new interpretation of what affordability means. And then a couple more years later from that, we have another interpretation of what affordability means, and that links to relending. And so we had this principle that's been in place for 7 or 8 years, and yet it's been interpreted and reinterpreted time and time again. And what happens is nobody's too bothered about the reinterpretation now if we're looking forward. But what happens is the lender is then told, okay, we said you were doing it right all the way along, but now could you go back and change it all? And could you pay back all of these customers? And yes, we've reinterpreted, but that's just what happens. That's what happens on principles-based regulation, principles-based system. And then, of course, if you have smaller lenders, if they're not banks, well, that will close them down. And that's what's happened to Wonga. It's happened to, could happen to Amigo, could happen to Provident. None of these were maverick lenders on the edge of the market. All of these were market leaders that had been under the scrutiny of the FCA for many years. And at some point, the FCA turned around and kind of said, yep, our interpretation has changed. Now go back and apply this. And of course, that's the thing that brought them down. I think that lack of certainty is the real problem, not just for commercial lenders, but for all lenders, will be what does the FCA actually mean? And will that be the same in 5 years' time or 6 years' time when this is looked at again. And I think it's obviously an area of concern for me, an area of frustration, but it's definitely something we should be talking about as consumer credit, and we should be talking to the regulator about.
Yeah, I mean, it's very frustrating. I mean, I think, you know, the city watchdog eventually gets to the right place, but I think you're right. They should have got there years before, you know, and not allowed these practices that decided were wrong to happen. Quickly, one last question, and I'm going to hand back to Theo, because from Valentine in Holland, it comes back to where we started from, talking about Provident. He asked, what needs to happen to allow responsible lenders to fill the market gap left by Provident? Who wants to answer this? Faisel then.
Thank you. It really comes back to what we've been talking about from the beginning. I think it's that in order to fill this gap, we need to find new ways of getting to those customers as quickly and as efficiently as possible, whether that's through technology or broader connectivity with wider community organizations and partners. We need investments in technology to allow us to make smarter and better decisions so that we don't make the mistakes that others might have made. And we need access to capital. And if we get all three of those together, I think we could easily take on the challenge of addressing the shortfalls from Providence shutdown.
I'm really glad your dog had some serious and strong views on that. Well, I'm glad to hear him or her. Listen, I've really enjoyed this discussion, and thank you all for your contributions. There's a lot of things going around my head, and I expect there is for the audience. And now I'm going to pass back to Theo. Over to you.
Thanks, Simon. Well, I have to agree with Simon. That's been a really fascinating discussion this afternoon, and so much food for thought about what the wider sector, and I think what's been referred to as the ecosystem here, will do next. So to close out, I'd just like to thank our panel of speakers again today for their time and their really valuable insights. And I'd also like to thank everyone who's been in the audience with us today for joining. We've had over 60 people on the call. I hope you found this as thought-provoking as I have. So do check out the Responsible Finance website for more information about our 10 times RF events and content. If you'd like to find out more about CDFIs or work with us, please do get in touch. So thank you again, and goodbye.